Okay, futures looking down a little, but it still could be the best week in a year for stocks. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, big no, he won't go. Fed Chair Jay Powell says Donald Trump can't fire him, even if he tried.
And the Trump rally takes a little bit of a breather, at least for now. Futures look like they're giving back some of the big gains chalked up after the win sparked a risk-on frenzy across assets.
And who says that revenge travel, is over? Online travel giants' results signal the post-pandemic boom still going strong. All that and more coming up, but let's take a look at these markets. A really interesting week, like Matt said, maybe a little bit of a breather. Maybe that post-Trump win rally went a little bit too far, at least that's what you're seeing in the market this morning. You can see the S&P 500 down just 0.1%. Those losses were a little bit steeper earlier this morning, coming back a bit. Same story if you take a look at big tech, your NASDAQ 100 down about 0.3%. And then take a look at the bond market. Take a look at that 10-year Treasury yield. We are currently trading at 432. That number was closer to 450 just a couple days ago, but at least for right now, we are unchanged on the day, Matt Miller.
Yeah, we're trading back to last week's level across the curve. This chart is insane. Take a look at it on your own Bloomberg terminal if you want. It's 1362, so you type in G #BTV1362. It shows the premium investors are willing to pay for U.S. earnings over European earnings, and the spread has hit an all-time high. When is that going to turn around?
Certainly investors not betting against America. There are some single stocks they are betting against, though. We're going to look at Pinterest here. The outlook is spooking investors as the forecast is a drop in demand from certain advertisers. Pinterest down now almost 12% pre-market. I'm also keeping an eye here on Icahn Enterprises. Think this one is interesting. Carl Icahn, of course, is betting on deals, but he's cutting his dividend to do so at Icahn Enterprises. The stock of Icahn Enterprises now down 6% pre-market, but the reason he's doing it is for a stake in CVR. Looking at NRG Energy as well, boosting its guidance. EBITDA for the full year, the guidance beat the average analyst estimate. The stock now up almost 5%. Event-driven activity, earnings-driven activity, a lot to talk about.
Yeah, a lot to talk about. Doesn't it feel like Friday got here fast? I mean, what a week we have had. I mean, I just feel like the week has flown by. We had the election. All of a sudden, we had a winner. Then we had the best post-election rally of all time. We had the best Fed day this year in terms of stocks, and all of a sudden it's the weekend.
Okay, this week has felt about a year long, but I see your point. To the point, though, that you made on the best Fed day rally, it was interesting how little of an impact the Fed decision actually made, and the press conference as well. We got some spicy headlines out of Jerome Powell, but markets were up before that. They barely moved. It was really all about the Trump trade this week, and now maybe the unwind.
If everyone was excited about all the action earlier this week, you actually now not only have bond market volatility much, much lower, almost at the one-year average, you also have the VIX below the one-year average. So that is just how much the markets have calmed down from 2 days ago.
All right, let's get to our guest out of Newport Beach. Erin Browne joins us from PIMCO, where she manages a portfolio. And Erin, I got to ask first about the Fed. As Katie mentioned, the markets didn't move at all. They did remove some language from the statement, no longer saying that they've gained greater confidence in inflation moving sustainably towards their target. Do you think they're laying the groundwork for a pause?
I think the Fed right now is very much in a data dependency state, in which they're really looking at the culmination of data that's coming out meeting to meeting, but also obviously over a 3, 6 month and 12-month period to really understand what is the evolution of the data. They're in between, as Jerome Powell mentioned, in between summary of economic projections right now. They're not going to refresh one until the end of this year. And so I think as a result of that, they're really very much in a data dependency stage and will decide whether or not to cut 25 basis points in December after we get a couple of more data prints on payrolls as well as on inflation.
You know, it's interesting. As there is caution coming out of the Federal Reserve, the bond market is still reacting so heavily to politics. And who knows what the ultimate policy might look like. We're still also waiting on the final outcome in the House. How do you think about the bond market's moves from here? We have erased almost all of the losses since Wednesday. We're still a little higher than we started the week, Erin, but not by much in the 10-year yield.
Right. Well, a lot, I think, has been priced in prior to the election with respect to the bond market. And the bond market was already anticipating that Trump would win. And so I think that as a result of that, you're not seeing the same follow through in bonds as you are seeing in equities, which are still pricing off of what has been a very good earnings season. I think with respect to bond markets, from a medium-term perspective, bonds at the current levels that they are right now, we think offer really good value. There's going to be some volatility around sort of a range, but we think that we're as we approach sort of the mid 4% and above level, that's a really good value to start to buy bonds again for longer term or medium term investors. I think as it comes to between now and year end, the market is going to remain fairly tightly range bound, really just in anticipation of what could be a more stimulative future in 2025 and beyond.
Erin, let's talk about the relationship between bonds and between stocks. I was having a conversation with Bob Michael over at JP Morgan yesterday, and he said that once you have Trump actually enter office, return to the White House, when some of these policies actually come to fruition, you could see the 10-year Treasury yield maybe knock on the door of 5%. And at that point, that is a very difficult level for stocks to absorb. How are you thinking about that relationship, particularly because it seems like nothing is slowing stocks down right now?
So I think what matters is really the pace of the bond market sell-off. And if we start to see the pace accelerating that of growth, so you're seeing real yields rise at a faster pace than growth, that's a point when it really starts to eat into equities and starts to hurt equities. We've been in an environment over the last couple of years where bond yields have been well above 5%. And, equities have still done well in that environment. So what matters and what I would focus on as an investor is the pace. Are we seeing growth that is, helping to absorb some of that shock of higher rates? If the question is no, and you're seeing rates sell off significantly and growth isn't really moving, that's the point where equities really start to get hurt.
Can you look at, Erin, the blueprint from 2016 and make some moves in your portfolio for 2024? Have you done that post-election?
Yes, of course. And I think that the whole market is really looking at what worked in 2016 and what the sort of corollary could be for 2025 and beyond. What I'd say with regards to that is one of the things that we're looking at are stocks that are really exposed to tariffs, where we could see, more heightened sense of tariffs, or at least threat of tariffs, really start to eat into earnings because they rely a lot on imports, versus stocks that are more insulated from tariffs, that are more domestically oriented. And we think right now is the time to bet on the U.S. So betting on companies that don't have a lot of exposure to imports, that are really geared towards the U.S. and the U.S. consumer and businesses, we think are going to likely outperform over the next couple of years. And we think that the policy directive from a second President Trump presidency is really going to be geared here on shore, geared towards lifting the U.S. at the expense potentially of other countries.
Tariffs seem to be a near certainty, and I think the degree of which you see them is really what's still sort of in the air until he comes out and really makes a more significant declaration now that he's actually won the election, right? So how do you think about how long or how short you make that trade around tariffs, in particular when you're thinking about the stock market here?
So firstly, we think that the threat of tariffs is a near certainty, not necessarily tariffs itself. And certainly we are going to see, continued focus on tariffs in the market over the next year and beyond. But I would be hesitant to just throw the baby out with the bathwater and sell stocks, unilaterally just because you think that, there's going to be a significant tariff impact starting next year. Firstly, we expect that the threat of tariffs are probably going to start pretty early on. That said, we also think that there's going to be room for negotiation. And what President-elect Trump has said is that he's going to use tariffs in order to try to extract leverage and concessions out of some of our trading partners. And we think that that pressure is really going to be a threat, which could be implemented, but it will be implemented if the concessions aren't met. So all of that said, I think you want to be very focused on your portfolio, which companies are most exposed to imports or have significant trading relationships where their earnings and margins would be hit materially if we were to see tariffs imposed. And some of that can just be done on a sector level, similar to what we saw last go around. But I think that those companies that are really exposed to China imports in particular are ones where they're going to have challenges, I think, with respect to earnings in the quarters and years ahead if we were to see significant tariffs imposed.
And Erin, when you add this all together, of course, we've been talking a lot about the political landscape, what proposals, promises might actually turn into policy. But when you take a look at corporate America, what we've learned throughout this earnings season, where does that leave you with conviction when it comes to the sector level of this equity market?
Sure. So corporate earnings have been actually quite solid, and we've seen from a number of consumer companies comments around the consumer actually starting to ramp back up as we came into the third quarter of this year. There was a lull or a period of weakness that was experienced over the summer with respect to the U.S. consumer. That seems to have been resolved, and we started to see more positive data coming out from some of the consumer companies starting in September of this year. And that's on the back of what is still a very healthy corporate environment for businesses in America. So we're still seeing a fairly healthy environment for the U.S. And the U.S., I think, is the best of the bunch amongst DM right now with respect to corporate earnings growth and the health of the consumer. So where that leaves me is really focusing domestically on the U.S. We really like companies that are pretty well insulated, as I mentioned, from some of the weakness that we're seeing from the rest of the world with respect to China in particular, and also that are more insulated from tariffs. Mm-hmm. We think that the power AI trade still is really good, and utilities is a place to invest for next year.
Erin, we thank you so much. Happy Friday to you. We appreciate you joining us this morning. That is PIMCO's Erin Browne. Now let's get a look at some stocks moving ahead of the opening bell. Bring in Abigail Doolittle.
Let's start off with the shares of Airbnb, and they're doing a tremendous reversal because in the after hours when this company reported, the stock had been up more than 10%, now down nearly 7%. So investors really changing their minds. What they liked was the fact that they beat earnings. In addition, the fourth quarter nights booked growth better than expected. On the other hand, as analysts and investors parse through the details, it appears that investments are going to weigh on margins. This stock right now down about 7%. Turning to the shares of Docuity, though, not so much. Absolutely soaring right now, up about 35%. They beat in a big way. Earnings of 30 cents, 18% better than what analysts had expected. Sales 8% better. So a strong quarter reported. Plus, they raised the forecast. There is a 9% short interest. So some of this gain probably a short squeeze. And then finally, turning to the shares of DraftKings, the betting company. Well, it's also reversed. Earlier, it had been down, now up about 0.5%. They did miss both earnings and sales. They cut the full year forecast. NFL game outcomes, quote unquote, customer friendly. They're saying that there's an impact. We'll be digging into what turned the stock around and watching it and reporting on it all day long, Matt.
All right, Abby, thanks very much. Abigail Doolittle looking at some of the stocks that are moving on this Friday morning. Coming up, travel stocks prepare for turbulence this holiday season. We'll talk about those bookings and whether or not you're still taking revenge. This is Bloomberg. Getting out of high interest, a look at what's making headlines around the world. German Chancellor Olaf Scholz is facing increasing pressure to hold an early election in January. A new poll shows that 65% of voters want a national ballot as soon as possible. Earlier this week, of course, Scholz fired the country's finance minister, Christian Lindner, citing divisions over Germany's economic revival, if there is one to be had. The crisis comes as Germany's economy stagnates and the country grapples with the re-election of Donald Trump. That raises the prospect of a new transatlantic trade war, even as their auto industry is already ailing from Chinese competition. Boeing CEO Kelly Ortberg is trying to patch up relations with workers after a bruising 7-week strike. He says the company will pay employees who were put on mandatory leave during the disruption at the Seattle manufacturing hub. The gesture of goodwill signals the CEO's attention has shifted towards mending operations. He tries to get aircraft output back on track. And Levi Strauss heir Daniel Lurie is set to become the new mayor of San Francisco, pushing out incumbent London Breed. Lurie positioned himself as a political outsider who could best tackle the city's homelessness, drug problems, and crime. His election underscores broad dissatisfaction with the status quo in San Francisco, a longtime tech boom town that has been struggling to recover economically from its trip way left into the pandemic. Katie?
All right, let's focus on shares of Airbnb this morning. They're actually falling right now. That's after posting double-digit gains in earnings. It had mixed results with book nights topping the street's estimates, while its investments were seen to weigh on margins. For more, let's bring in Bloomberg Intelligence senior tech analyst Mandeep Singh, who also covers Airbnb, which is a particular delight. Walk us through the reaction to these results, because you take a look at the after-hours trade. Airbnb was up 13% at one point. Obviously, a different story this morning.
Yeah, I mean, the forward guidance was quite constructive. They said fourth-quarter growth would be better than third quarter. So clearly, they are expecting room night growth to inflect here, and the travel demand would take that growth higher. What Brian said on the call was they are looking to invest more to drive, new products that can generate $1 billion in revenue, incremental revenue every 2 years. Now, that's where I think investors didn't have enough clarity on what exactly is he talking about in terms of investment, because the biggest criticism for Airbnb is it's still a niche company when it comes to travel, alternative accommodations. They don't have the complete bundle that your Booking and Expedia have, and I think that's where more clarity would help. But other than that, the print was solid.
Well, you think about Expedia, for example, it's up now more than 4% pre-market, and the divergence between the two. How much of a moat does Airbnb have? How much room is there for others to catch up in a much greater way? How do you fix that gap?
I mean, look, Airbnb trades at the premium multiple when it comes to travel market. So when you compare it to Expedia, Expedia trades at a much cheaper valuation. And so the print was solid. But in terms of, the free cash flow that Airbnb generates versus the rest of the peers like Expedia, it's far ahead. And that's where, their moat is sustainable, because the biggest thing with online marketplaces is supply growth. And when it comes to Airbnb, it's got that unique supply of, these vacation rentals that nobody else has.
It's practically a monopoly, right?
It is a monopoly.
There's Vrbo. Is there really any competition?
I mean, in terms of listings, and Brian emphasized the quality of the listings last night, it's not even a comparison. So clearly, Airbnb is way ahead. And when people talk about, disruption from generative AI agents, changing the way people book travel, it's so hard to acquire supply when it comes to online marketplaces. That's why you don't have Google as a competitor to Airbnb, because supply acquisition is the hard part. So I do think Airbnb's problem is the saturation in vacation rentals market, which is what Brian is trying to address. And he alluded to, the fact that they'll be launching a lot more newer products. But there wasn't enough clarity on what are the areas they'll be launching new products on.
All right, Mandeep Singh, it's always great to see you. Of course, that is Mandeep Singh of Bloomberg Intelligence speaking to us about Airbnb. Let's bring you some breaking news. This from Bill Ackman in a post on X, saying that he is seeking to remove Pershing Square Holdings from Euronext. Of course, this is the Amsterdam exchange, seeking instead to concentrate the listing on one exchange, the London Stock Exchange, which he says in the post now represents more than 90% of our trading. Also in this post, guys, he says that events in Amsterdam during the last 24 hours provide an appropriate tipping point for this conclusion, of course, after Israeli football fans were attacked in Amsterdam.
I mean, that's not of course. I had not heard that until you showed me the story. So I think a lot of people will not know this, Dutch police have arrested 62 after attacks on Israeli football fans. Of course, Bill Ackman has been front and center when it comes to anti-Semitic his concerns about anti-Semitic protests in this country and anti-Semitic violence over in Holland. So I think this is a pretty interesting story. He's going to focus now just on London.
Right. Well, two things about that. To your point, this is both about business as well as about politics. He says it's a site to protect tourists. He wants to move to a place that's more friendly to minority populations, to your point. Also want to cite his conversations with Universal Music Group as well, which is domiciled in Amsterdam. He says that Pershing Square has a contractual right to cause Universal Music Group to be listed in the U.S. You're actually seeing UMG shares up after his tweet as well. The case he makes is that UMG trades at a large discount to its intrinsic value because of limited liquidity, in part by not having a U.S. listing. Katie, I know you're watching this very closely, the changing of listings. A lot of people betting on U.S. markets. Bill Ackman capitalizing on that.
Yeah, well, two different things. This, of course, is the closed-end fund that has existed in Amsterdam for several years now, separate from the closed-end fund he's trying to launch in the U.S. But like you said, a blending of business and politics here. Like he says in the Post, already 90% of the trading in London, but now, of course, trying to move the listing altogether following Amsterdam. All
right, we'll continue to follow this story for you as the news breaks. We're covering the market, obviously, front and center here. Just 7 minutes to go until the start of trading, and this could be the best week in a year for stocks after an historic presidential election. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. If we don't fall 0.2%, then we're going to have the best week in a year for stocks. Not that that matters. It's just one of those fun superlatives, like Wednesday was the best post-election day for stocks in recorded history, for the S&P, I mean. And yesterday was the best day for stocks on a Fed day in 2024. You hear the opening bell. There are some people ringing. Apparently, Roberts Ryan is ringing the bell for Veterans Day. It's a veteran-owned business down the New York Stock Exchange. Of course, Veterans Day isn't until Monday. And they're going to keep trading. I think it's kind of disrespectful to work and trade on Veterans Day, but we're going to do it anyway. Crane shares ringing the opening bell on the NASDAQ. In terms of the indexes, it looked like we were giving back a little bit of the gains, Katie Greifeld, that we have built up, the big gains, more than 4% over the last few trading days. But now the S&P is positive. What do you see?
Yeah, the color is green behind me. If you take a look at the S&P, like you said, this is a week that's rich with superlatives. And as such, maybe we're taking a little bit of a breather today. You take a look at these numbers, really small moves overall after all the fireworks that we saw this week. The S&P 500 higher a little bit. The NASDAQ 100 deciding what to do on your big tech names. Same thing, too, if you take a look at the small caps. The small caps have really led the charge this week, but now a little bit of a breather. Meanwhile, you take a look under the surface, and we have to talk about Pinterest. Just a wipeout underway. Sales, of course, for the holiday quarter are lower than expected. The company cited weaker demand from food and beverage advertisers, currently off about 14% on shares.
Katie, I'm also keeping an eye here on DraftKings. I think this is an interesting one. It cut its full year estimate for 2024 as revenue and profit because of gamblers getting lucky in the first part of the fourth quarter. I think that's fascinating. I'm a gambler myself, and it should be paying out. Stock was down. Now it's up about 1% as the market opens.
How much do you typically bet in any given month, Sonali?
Just a few bucks, Matt. Nothing crazy. And in fact, I have stopped myself from any parlays.
That's good. That's good. You don't ever want to do anything
Limits.
like that with a French name. Lucid posted a better than expected loss after the EV makers push to cut costs gathers momentum. The company just started taking orders for its Gravity SUV, which you see in this short clip here. I'm not sure it's a terribly attractive vehicle. It kind of looks like a Honda, Nissan, Toyota, like a short Odyssey. I'm not really pumped on it, but the stock is up, and it hasn't gotten killed by Tesla competition over the last few days, which you may have expected post-election. Let's take a closer look at where traders are placing their bets this morning. For that, we go to Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, this, of course, has been the week of the Trump trade, and here it is with the S&P 500 up more than 4%, the better part of 5%. In fact, the best week in about a year as investors are cheering on the idea that President-elect Trump, his potential policies of tax cuts and protectionism will be good for the U.S. economy. But it's not just the S&P 500. The Russell 2000 posting its best week, or heading to its best week, I should say, since February of 2021, up 7.7% right now. Bitcoin up a very healthy 9.9% on the expectation that Trump's administration will be friendly toward the crypto space. It is interesting, though. We did have on the day after the election, the best day for the Bloomberg Dollar Index, up more than 1% since 2020. Now a very small decline there. And then the 10-year yield, which actually had been soaring as well on the idea that some of the budget spending may not be so friendly toward bonds and yields. But right now down about 8 bips, 9 basis points. That could also have to do with the Fed cutting once more. And then when we put it all together, Katie, for some of the stocks that are either linked to Republicans or Democrats, well, on bottom, you can see the democratically linked stocks have really plunged. This having to do with the idea that there could be a trifecta in Washington for the Republicans. And then the Republican-linked stocks off of the highs, but pretty close net on the close of this week, or at the open of the close of this week. We do have stocks again cheering that Trump trade.
Abigail Doolittle, thank you so much. A great setup for our conversation now with RBC Head of Derivative Strategy, Amy Wu Silverman. And Amy, this has been a week that's been defined, at least in the markets, by that Trump trade. Of course, all that enthusiasm behind it. And now today, maybe a little bit of an unwind. When you take a look into the options market, when you take a look at positioning, how much more steam is there in this trade?
Hey, Katie, look, I think that is certainly the question of the day, if not the question for the next few months. Look, one thing we've been talking about is when you looked at the first half of this year, the narrative was really about AI, about mega cap tech. And you really saw that in the options positioning. People felt like they had FOMO. They felt like they couldn't miss out. And so you saw a lot of call buying. You saw that right tail wing being really important. The reason I bring that up, Katie, is we continue to see that in the Trump trade, even though we've had these substantial moves. So I think, 9 out of the 10 conversations I've been having is, how much room is there left in IWM? How much room is there left in all these Trump baskets? And when you look to the derivatives market, you still see relatively healthy bullish sentiment there, which tells you that momentum, maybe it flags for a little while, but it certainly could still continue.
Well, to that end as well, when you see momentum picking up, what does it mean for volatility? Because the drop-off you saw in the VIX has been pretty stunning. It's been hanging out closer to 20 for a little while. Now it's back below 15.
Yeah, you're exactly right. And if you kind of remember, a couple days prior to the election, there was a massive volatility premium, almost 2x what the average VIX level has been this whole year. And, we've gone back down from that psychological 20 handle or back to 15. Here's one thing I'll say that I think investors forget, and this is what it is. You can have the stock market move up and volatility move up. It's actually a dynamic that we've seen a lot more post 2020, where we say spot up, vol up, because look, when people buy call options, it's still moving volatility up. And so those things are not necessarily mutually exclusive, because that correlation of, VIX up means stocks down, that has not been true. And so look, if we do see a second wave, that could still mean that volatility is rising. You could see that VIX handle rising, because ultimately VIX is just a compilation of the weight of S&P calls and S&P puts.
We had polls that were horribly wrong once again. Betting markets we weren't too sure about with regards to the election, because there was a big whale in one and you could only buy in if you had crypto, and the other one only had an $850 limit. So there was a question mark there. You say the options market really gave us the answer. Lay out how you could see in the options market that Donald Trump was going to win by such a wide margin.
Yeah, I would say I've been personally very fascinated by this dynamic, in particular because the polls have been so incorrect to the magnitude. And you brought up the whale trade. I thought the whale trade was very interesting, because not only was that a bet on Donald Trump winning. It was also a bet on him winning the popular vote. So it's a very specific bet. And it all comes down to what was it that was missing in the polls that was priced by derivatives, that was priced by the probabilities in the options market. One thing we saw, just to give you a characterization, is that while the election was still ongoing, so polls hadn't closed yet, we saw the biggest crush in volatility risk premium. And then we saw these Trump baskets start to trade up. We saw the right tail volatility start to trade up in IWM. So the market was very strongly pre-trading a conclusive Trump victory the day of the polls. The polls hadn't even closed yet. And that's a very interesting signal to me, because right now, we're still waiting on the House. But the market essentially is still continuing to trade as if we're going to get a Republican sweep. And, one question I have going forward is, if people start believing that the polls are not reliable, what are your secondary signals? And it does seem to be that equity markets and equity volatility has been more efficient here.
Yeah, you make several good points there. First of all, like on 7 p.m. on election night, it was just wild to see markets take off. And to your point, it's a big vindication for the betting markets, but also for the volatility markets. And I'm curious how the volatility market, particularly intraday volatility, might evolve if we see Trump return to Twitter, return to X in a big way. If you think about 2016 on, it felt like every day could be dictated by whatever Trump tweeted that day. Are we returning back to that market?
Yeah, you're absolutely right. I was kind of laughing because I have like a special blip on my Bloomberg screen that will just start to highlight the Trump tweets again, because we'll need that for all the volatility that will come. I would say that the one kind of question that our investors have been talking about is we've had this knee-jerk reaction where, VIX has sold off, volatility has sold off. But there are certainly a lot of questions of whether or not it should be higher, because in the 2016 to 2020 regime, you do get these big volatility pockets as it comes down to Trump and, the way he kind of delegates information and makes surprise choices. A simple example I'll give you is just when he tweeted about Deere. And you saw idiosyncratically what that stock did. I think when we speak with portfolio managers, that's the kind of angst that they're bracing for. And it's difficult to hedge those kind of risks because they're not necessarily catalyst dependent. They're really, much more whim dependent. And so how do you price and how do you scale volatility in that situation?
Amy, we thank you so much for joining us today. Watch out for maybe some more volatility. We'll see it's low today, but who knows what's ahead. RBC head of derivative strategy. Now, coming up, Pinterest posts a week holiday forecast. We're going to give you details of that next. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a look at this stock market right now, because at least the S&P 500 a little bit higher right now, to the tune of about 0.1%. We are close to up by 4.5% on the week. Of course, that would be the best week of this year, so keep your eyes peeled. It's time now for our top calls, some of the analyst action in focus this morning. Let's start with Telsey Advisory Group, upgrading Home Depot to a buy ahead of the company's earnings next week. The analyst says that the DIY home retailer could be a beneficiary of the Fed's latest rate cut. Next up, we have Barclays downgrading Bath & Body Works to a sell, also cutting its price target. The analyst says that there's a risk that sales will slow because of the weakening economic picture, so a little bit different attitude there. But he also notes that the company could underperform the broader retail sector. And finally, we have Goldman cutting its recommendation on Sweetgreen, saying it's no longer a buy. The salad chain reporting disappointing third quarter results thanks to higher labor and protein costs. Sweetgreen hasn't turned a profit since it went public in 2021, Matt. I know. All that money we spend there, and it still can't turn a profit.
That's insane. I'm paying like $18 a salad there almost every day, and they don't turn a profit?
Not yet.
Man, I just wonder, where do you have to price a salad to be profitable? If not $18, what are we talking about, like 25, 30?
Protein's really expensive right now.
All right, fair call. All right, let's get to some more earnings news. More disappointment here. Pinterest shares plummeting after forecasting low sales for the holiday quarter, citing weak demand from certain advertisers. Let's discuss with Bloomberg Technology co-host Carolyn Hyde joins us here on set. This is, to me, it's always been fascinating, Pinterest, because it pops up in my internet searches a lot, and I go to buy stuff, and I'm always disappointed because it's just like some lady's collection of jackets she likes, right? They're trying to change that. They're trying to boost buyable content, but it doesn't really seem to be working.
Well, I think they'd argue that it is working and that people come there with intention, that people go there because they're getting married, because they're refitting a house, they're having a baby, and therefore you go for their products, you search, and they are trying to therefore invest in AI, generative AI, that much more, so that you can more seamlessly get the content that you want, find the images that you need, and eventually will be shoppable, more shoppable. And that's certainly been why advertising has been drawn to it. Look, the shares are plummeting. This is after, actually, they had a pretty nice third quarter, and they had double-digit growth in terms of users. Maybe Matt's one of them, a new one that they've just added in terms of monthly active users. Loads of them are outside of the US. You've got about 300 million outside the US, 99 million here in the US. But they are managing to see double-digit growth in revenue. You are seeing 40% increase in earnings per share. And they guide for more double-digit growth in revenue going forward.
But Caroline, their shares were down 8% year to date. And this has been a pretty damn good year for stocks. So something is not impressing the market.
And what's interesting is also their valuation is way lower than like a Meta or a Snap in terms of forward price versus future earnings. So why are people still questioning? The cost of generative AI is a lot. Look, they're upgrading the operating expenses are going to be up to $510 million for the fiscal fourth quarter. So we are seeing that they're having to plow money into generative AI. And people want to see, to your point, Matt, when are we going to get the shoppability? When are we going to see advertisers rate Pinterest at the same as a Meta when they're going for Instagram, when the same as going for other competitors in the space? Because many feel that sometimes it's a bit of an also-ran when you're putting your ad dollars to work.
Yeah, it's a good point, too, that you make on valuation. Though I will say I was surprised this morning to see that its market cap is still above $22 billion. Not what I would have expected. But
it's got loads of users.
It's true.
Got way more users than X, for example.
Right, but expand on the competitive landscape a little bit more when it comes to ad. You mentioned Meta, you mentioned Snap. I have to imagine that when they're trying to chip away at that, that's a tough hill to climb.
It is, and I think when all marketeers are out there spending, all boats rise. But to your point, you were pointing out earlier when you looked at the share price plummeting, the first point after trade opened, it is about food and beverage. I mean, who knows what's happening at Sweetgreen, but ultimately these companies, this is a result of the election. A lot of people are strapped for cash. People aren't spending as much on a Coca-Cola or particular some of the CPG units, and therefore we're likely to see maybe just a bit of a drawback going into the holidays. Also, maybe just the market got ahead of itself.
To your
was
point,
really exuberant.
Seen that before.
To your point, they have tons of users. There are assets here.
It's a different kind of user than an X user, right?
Well,
Can you really make the comparison? People live, sleep, eat, and breathe X.
I don't.
The more,
and I'm still a user.
The more that you see the price drop, how much more does it become either a acquisition target or an activist target?
Oh, well, from a perspective, I'm sure that the investor base are one that they're going to be having to talk to a lot about whether or not this is vindicated in terms of the purchase price. But I mean, I'm going to go into analyst recommendations. Overall, people have been relatively buoyant. We're seeing a lot of price targets cut come today from some of the analysts out there, but a lot of them still have a buy. 30 of them have a buy, 0 have a sell at the moment. So whether or not they see potential opportunity for this company to just re-accelerate into the second half of the year, I think many feel that they can return this one around when it comes to the view on advertising spend going forward.
Caroline, we thank you so very much. That is Bloomberg's Caroline Hyde, of course, co-host of Bloomberg Technology, which is on right after the show at 11 o'clock. Don't miss it. Coming up, BlackRock. We're going to talk about its talks with Millennium for a minority stake. But will it result in a deal? That's next in our Wall Street beat. This is Bloomberg.
Welcome back to Bloomberg Open Interest. It's Friday. It's been a crazy week in the stock market. You wouldn't necessarily know it by looking at the action today, a little bit more muted, but some interesting trends developing. You now have the S&P 500 firmly in positive territory, up about 0.2%. The NASDAQ 100, it's trying to go green. It seems like it got there, at least for this exact moment. Pretty much unchanged on the day, though. And small caps also fighting back as well from their pre-market losses. The Russell 2000 currently higher by about 0.2%.
And Katie, it's time now for the Wall Street Beat. BlackRock is in talks with Millennium to sell a minority stake in the hedge fund. If a deal comes to fruition, it would be the first time in its 35-year history that Millennium had sold a portion of its business to a third party. Joining us now is Bloomberg hedge fund reporter Hema Parmar, who, has been following Millennium very closely. It has been changing a lot over the last couple of decades, certainly a lot in the last few years. When I think about BlackRock and I think about Millennium, both leaders are thinking about the future of finance, the holes that they're filling in the financial industry. Millennium stepping up in a bigger way into really the market-making hole that banks are leaving behind. BlackRock sees that. What's the rationale as we know it?
Yeah, so if we look at it from the BlackRock point of view, this is a firm that is getting bigger and bigger, is pushing more into alternative finance. You've seen them trying to buy HPS. And if we see this deal, if it does come to fruition, we should say these are early stage talks. We don't really know how it will pan out. But this could be seen as a way for the firm to get bigger, to become a one-stop shop for all things, including having some access to a sizable hedge fund.
Let's talk about Millennium a little bit more. Like Sonali said, this is a company, a hedge fund that's been changing. You think about their assets. I thought it was so interesting that they tried to raise as much as $10 billion, but they were oversubscribed. I mean, Millennium, it seems like everyone wants a piece.
Exactly. Over $20 billion of demand, and they capped it at $10 billion, which is still a huge amount of money. So you can see that there's a waiting list of people trying to get into Millennium. And you can see that this is a firm that has posted pretty strong returns almost every year that it's been around. And so they're sort of highly looked at. But what's interesting with these talks is that this is the first time that Millennium would have ever had sold a portion of its firm in its 35-year history. So, and you're seeing this is a firm that has been institutionalizing itself in some ways. The leaders at the very top are now essentially an office of the CIO.
So, I mean, it's a $70 billion hedge. Sorry, did you?
Well, yeah, one thing I had to ask about, too, is the succession here, because to your point about institutionalization, who are the people under the hood? They've been making a lot of changes, and I think that matters as they potentially have this talk with BlackRock, because what happens one day if Izzy Englander steps aside?
Right. And so if we look at the firm, for a long time there was, chatter about, okay, it being one person, whether it be Michael Gelband, who has left, or somebody else. And now if you look at the firm, it's with this essentially a office of the CIO, multiple people at the top running the firm, it feels more like a larger, mature firm run by many people and less potentially personality driven. Though I should say, Izzy Englander is still at the top and still running things, of course.
Thank you so much, Hema, for joining us on this story. I thought it was a big story for Millennium, but for BlackRock, I mean, this is a $70 billion hedge fund. What does BlackRock have in assets under management? 10 trillion?
$11.5 trillion.
$11.5 trillion. So it's a drop in the
point,
bucket. Are they making a ton of money, Millennium? Are they beating the benchmark?
Fees. It's about the fees.
Is it still 2 and 20?
Well, is it? Yeah,
Probably
higher.
more than that.
For Millennium,
Pass-through fees are expensive. So it's definitely more.
Millennium and Citadel, these are the two biggest multistrats, and they are largely considered the future of finance in a lot of ways, especially as bank trading desks shrink. And so if we think about BlackRock's next move here, this is just as much about positioning for the future.
I mean, BlackRock wants to make more money. BlackRock wants to get into private assets because they earn nothing on those ETFs. It's a story as simple as that.
I get it, but I mean, if it's the future of finance, I feel like, why isn't it way bigger than a measly $70 billion? Okay. We trade $3.5 trillion companies.
People away to keep it to $70 billion.
That's a very good point. That's a really good point. If it gets too big, it's much harder. All right, we're going to continue to cover this kind of stuff in Wall Street Beat for you. And we have a special Wall Street Beat interview in the next hour. Perella Weinberg CEO Andrew Bednar is going to join us. That will be a fascinating chat about M&A. Plus, we're going to talk about the consumer, a Tanger CEO, Stephen Yalof, as well as Affirm's Max Levchin. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. You take a look at markets right now. The S&P 500 hitting session highs. We are on track for our best week of the year. We are waiting some data, this from the University of Michigan, on sentiment. Very interesting, of course, after the election. Matt, what do we have?
It's a beat.
Wow.
We get a 73 on the headline number. We were looking for only 71. Let's get over to Michael McKee straight away, our economics and policy reporter. And Mike, my main question is, did they call people up on Wednesday? Like, did the survey participants know that Donald Trump won the election and won the popular vote, won all the swing states, and may have a red sweep?
Well, we're going to be talking with Joanne Shu, the director of surveys at the University of Michigan, on Bloomberg. You can tune in on Live Go coming up in about 15 minutes, and we'll find out. But the way they collect the data, Matt, is basically throughout the month. This is the preliminary report from the University of Michigan, and they'll be collecting data all this week and into the coming weeks until we get to the end of the month. We get the final number. So there would probably be a day in there, or maybe two, day and a half, that would reflect it. Now, then it depends on how many people they had reached by that time and whether or not they were fans of Donald Trump or not. One of the interesting things that happens when you see these numbers is that and I'm just looking to see if we've got it updated yet, who thinks the economy is good and who thinks the economy bad absolutely switches when the parties switch. And right now, Democrats have been the ones for the last 4 years that thinks things have been great. So it'll be interesting to see if that moves. It hasn't updated yet on the terminal. Current conditions, 64.4. That is down. Even though this headline is up, the current conditions is down. Expectations is up. 78.5 from 74.1, and maybe that reflects Republicans' thinkings about what Donald Trump will do. Inflation numbers for the Fed, good news, 2.6% on a one-year basis. That's down from 2.7, and on a 5-year basis, 3.1% goes up. Fed doesn't pay as much attention to that. They're going to pay much more attention to the one-year inflation number, especially with CPI coming up next week, and what Jay Powell said yesterday about inflation not being great, still being low, but not going down as fast as it was before.
Well, Mike, let's quickly talk about the Fed's path from here, because it was interesting. You saw Goldman Sachs out changing their 2025 Fed call, pushing it back. They basically see a slower pace of cuts. Interestingly, they didn't name drop Donald Trump at all. This was all based, of course, on the economy, on Jerome Powell's performance yesterday. What are you hearing in the aftermath of course, the election and the Fed meeting yesterday?
Well, the Fed is going to ignore what's going on with the election and the Trump administration's ideas, because that's basically what they are. They're just ideas at this point, as Powell made clear. Until we have something we can actually model and try to figure out what it means for the economy, other than in broad generalities, there's nothing we can do. So the focus really for the Fed and the markets is now going to be the December meeting, and that will be heavily influenced by what we get next Wednesday with CPI. One more CPI on December 11th, and then we, of course, get the big jobs report in the first week of December.
McKee, thank you so much for joining us, of course, and we're looking forward to your coverage all through next week of all the economic data ahead as well. Yields are cooling down.
Well, the one-year ahead inflation expectations fell to a 47-month low.
Wow.
Isn't that sick?
That is pretty
are
cool.
Mildly higher, so the market isn't listening.
47-month low. All right.
And remember, in just a few minutes, Mike will be speaking to Joanne Shu, the director of the UMich Surveys of Consumers. You can follow that conversation on Live Go on your Bloomberg terminal. We're going to switch gears. We're going to talk about the M&A environment in investment banking. Perella Weinberg announcing today the highest revenue in the firm's history as it reports third quarter results. The stock this week also hit a record high after Donald Trump's presidential victory drove Perella and its rivals higher in the hopes of a deal-making revival. We're going to dive deeper into those results and the outlook for corporate consolidation with the company's CEO, Andrew Bednar. Andrew, thanks for joining us here on set. Like we said, your firm has had record revenue, really doubling from a year ago. Just an incredible comeback. But into next year, how much more juice is there to squeeze out of the M&A pie right now?
Sure. Well, thank you. We are very pleased with the results for year to date in the third quarter. We've doubled revenue over the last year. We've had the record revenue for our firm in its history in the first 9 months. And you know, for the last 2 years or so, the industry has really been wearing a weight vest in the M&A markets. We've had a very muscular antitrust authority, not just in the United States, but globally. And I think that's going to be lifted here in the coming months with the new administration and the new policy tilt that we're going to have toward more consolidation, more pro-business, more stable tax outlook. So we think there's real accelerants now in the business, and it's a little bit hard to contain our enthusiasm. I think the question is whether you're going to have this rocket fuel be vertical liftoff like a SpaceX rocket. Probably unlikely. I think we're on a path to taking off and growing M&A, which we saw in the third quarter of 23. And I think that flight path is going to continue, probably gets higher faster than what we might have expected last week. But we'll still have some turbulence and some bumps in the road, I'm sure. But generally, the outlook for the transaction markets are very positive.
Well, Andrew, please don't contain your enthusiasm, because it feels like everyone, except for one Bloomberg opinion columnist, which Matt will bring up, but everyone is saying that we're going to see this M&A boom. And I'm curious where you see the areas, the industries that are most ripe to see that action. We hear financials, healthcare, maybe some energy all the time, but where should we be looking?
I think it's going to be very broad. It's going to be very focused in the United States. You know, right now we're touching about $3 trillion of overall activity in the United States. About half of that is in the U.S., 25% is in Europe. We're still seeing a real shift toward investment in the United States. I think that theme is going to continue. We've got, you know, the largest equity market on the planet. We've got 55 trillion of 115 trillion globally. There's just strong gravitational force to investing in the United States, not just for people buying stocks, but people who are business builders, entrepreneurs. Capital formation is here. We have innovative energy here. We have, I think, a risk appetite here that is second to none. There's no comparable around the globe. And so the markets are very poised globally to transact here in the United States, and I think it's going to be across industries. The one cloud that I see, that I may be in a minority on this, but I do think rates will be sticky. I think they don't come down that quickly. A little more Fed action this year, and then I think they're on pause. That won't be great for the financial sponsor community, which has largely not participated at the level they should be. If past is prologue, they should be 30+% of the market. They're trending at around 20. I think that recovery may take a little bit more time, and so anybody expecting, you know, again, the slingshot effect for sponsors, I think may be waiting a little bit longer to see that come about.
I wonder about the possibility of regulations getting slashed. I think a lot of corporate America is excited about it. It's the one aspect of the campaign promises that we haven't really talked about that much yet. Are there specific regulations that have been particularly restraining for M&A? Are there specific regulations that you would like to see go as soon as possible? What do you want from the president in the first 100 days?
Look, in our markets, what slows down M&A and what creates speed bumps is lack of conviction. Unlike the stock market or the election markets, which are prediction markets, we're in the conviction market. And conviction markets are quite fragile, and emotion plays a large role in that. And one of the real hits to the conviction markets for CEOs and boards has been the risk of antitrust intervention in otherwise strategically compelling transactions. And so even though the FTC and DOJ collectively have only enforced about 30 companies to take action around their M&A transactions, there's only been a handful that have terminated, only a handful that have gone to trial. There are thousands of M&A transactions a year. But the underlying story there, what's a double click down from there, is that the chilling effect has been very real. And so the time to close is a real barrier to assessing risk reward for an M&A transaction. So you think about it, if you go to a store today and buy a sweater, you're not going to wait a year to put the sweater on. But if you transact today in this type of environment for a transaction that really is not a consumer sensitive industry, they're still taking 6, 9, 12 months to close. And that presents an unreasonable risk reward for a lot of our clients that have decided to put some of their more aspirational transactions, at least in the warming drawer. I think they're going to get pulled out now as we head into 25. But those are the kinds of regulatory actions that we would expect. I think just a more reasonable and a little narrower scope on antitrust
But you think
enforcement
Lina
review.
Khan and this restrictive group of people that came in the Biden administration are gone?
I think it's hard to see when you have a senior level in the administration sticking around for the next administration. So, you know, the ideology won't unwind completely. I think that's not just a pendulum that's going to fall back the other way. I think the progression towards some more enforcement is probably here for a while. And I think some of it's warranted. I think we probably had some misses over the years with respect to consumer-sensitive industries and areas where I think enforcement didn't see where the puck was going with some of the technology transactions. But generally, I think it's going to be a little bit lighter touch, and that's overall good news for our markets.
And a lot of deal makers also point out that they just didn't win some of these. Think Microsoft, Activision. You know, another deal Matt and I were talking about earlier this week in particular was US Steel. We use this as an example because through the campaign, there was this idea that a Japanese company couldn't buy a US steel company, and now you have that.
It wasn't just an idea. Both candidates were extremely vocal about the fact that they would never let it happen on their watch.
Absolutely, and now you have Nippon Steel saying they think that the deal could close soon. And so, was that campaign rhetoric, or is there still going to be the threat of a protectionist stance as international companies look to those companies onshore, like you were talking about earlier?
Yeah, that raises an entirely different issue outside of the antitrust framework, which is, of course, politically sensitive areas. So national security threats, threats to our borders, those types of industries, I think, will face increased scrutiny under CFIUS and review that's done through the executive branch. U.S. Steel is obviously labor sensitive, so politically it has heightened issues for our leaders, and that puts you into a different category from, for example, a JetBlue and trying to merge with Spirit, for example.
Andrew, if you could just directly settle the debate for us.
I'm
Can you
gonna
imagine any
stay
world
over
in which
here.
Donald Trump allows a Japanese company to buy U.S. Steel?
Yeah, I would say it's always risky for me to comment on existing transactions that haven't closed. I would look at the market, and the market's telling you with a $20 plus or $15 discount today, something like that. It's a $55 all-cash deal, I think, and it's trading $41, $42. It's supposed to close in 2 months. That's a hell of a return if you can get that in the merger arb industry. So right now, the merger arb market is at least telling you they don't think it's going to close, or at least on the terms and timing that have been set forth by the folks in Japan.
Andrew, well handled. I was out yesterday, so I missed this whole
It was
thing.
heated.
I'm
You
sure
missed
it was. I'm sure it
You're probably
was.
glad you
Thinking about
missed
the
it.
cast of characters involved. Let's move swiftly along. Let's talk about sizes here, because we were having an interesting conversation, I believe, with Charles Phillips earlier this week. He was saying, at least when it comes to the tech sector, he's not expecting mega deals, that maybe you'll see more bolt-on acquisitions. How are you thinking about the size of deals that we might get? Are we going to see a return of mega deals?
We started seeing a very significant improvement in the large cap merger activity back in Q3 of 23. So for us, we see the planes on the runway before they take off. The public sees the takeoff and they say, okay, there's an announced M&A transaction. For us, we start to see it in air traffic control much earlier, and those conversations really started in Q3. We still were facing the speed bumps from the regulators, so there was still some hesitancy. But if we look at the way that we categorize some of our fee business, so large fees, medium fees, lower fees, our large fee business is up threefold from where we were a year ago. The backlog suggesting the same. And we're a small part of the market. We're still a relatively small player in the overall M&A market, but we do have a heavy weighting toward large transactions, and our teams are very busy on larger transactions. So as I said earlier, I think it's going to be across sectors. I don't think any one sector is going to dominate. I do think it'll be largely U.S., although Europe has a lot of room to grow, but I think a lot of that activity will be inbound into the United States for reasons I alluded to earlier. And generally, I think if you're a corporate executive still facing the same pressures as markets value companies based on growth and margin, and again, innovation and disruption continue to be factors for every executive that we talk to, you're going to have more M&A activity, and I do think it's going to be larger in scale given the more accommodative regulator.
All right, Andrew, so enjoyed this conversation. Great to get your insights on what that runway looks like. That, of course, is Andrew Bednar. He is Perella Weinberg CEO. Meanwhile, we do have some interesting news out of the stock market. DJT, this stock has been all over the place, particularly right now. It surged as much as 12%. It was halted for volatility. Currently trading again, you can see up 10.7%. We'll have to keep an eye on that one. Now, coming up, keeping the theme going, Donald Trump naming the first ever female White House chief of staff. We'll take a look at potential picks to round out Team Trump next. This is Bloomberg. Welcome back to Bloomberg Open Interest. Let's get back to DJT, of course. Moving, surging, getting halted for volatility. That's after President-elect Trump said in a post on the site that he doesn't plan to sell shares of Truth Social. This is a quote. "I hereby request that the people who have set off these fake rumors or statements and who may have done so in the past be immediately investigated by the appropriate authorities." So take that as you will. This was a post on Truth Social. We know that he's returned to X. But now apparently also back on Truth Social. Let's continue talking about Trump and, of course, what his eventual team, when he does return to the White House in January,
Can we just sort through fake rumors?
Yeah, go on.
Do you really need to say fake rumors?
I'm just quoting.
Does that mean it's not a real rumor?
A rumor, of course, doesn't imply truth. I guess that's correct. Well, he said fake rumors.
No, I know. That's a direct quote. You made it clear that it was a quote, but
he's going to be correcting grammar on it.
It's a little taste, of course, of the stock market volatility that we might see with, of course, Trump back in the White House, back tweeting, posting, whatever you want to call it. But let's talk to Stephanie Lai, of course, about what we know so far about who might make up Trump's eventual team. Of course, Susie Wiles was appointed as chief of staff. We know that she was involved in the campaign, Stephanie, but tell me a little bit more about her.
Certainly. Well, Susie Wiles is seen largely among Republicans as more of a quiet figure. But what's been so remarkable about her tenure is that she's been credited with having held some of Trump's more volatile or brash personality moments back. You know, she's largely the reason why they had such a professional campaign this last year. Much of her job has been corralling folks and making sure that the power is really centralized around the top brass. And that we've seen significantly less infighting this year because of it. And so largely, most of the campaign successes have been attributed to Susie.
I think it's pretty exciting to see. It's historic, and she seems to have a really strong hand. In terms of the rest of the cabinet appointees, we don't know anything directly from Donald Trump, do we? Even from sources via Donald Trump. We only know or have an idea of who could be in the cabinet from people around Donald Trump. At least that's what I read in Bloomberg reporting.
That's correct. You know, we've been hearing from sources of the people that Howard Lutnick and Linda McMahon are considering. But of course, these are all just names that allies have been floating. And this pool that they've gathered are largely names that allies are recommending. So much of what we're hearing is coming from some of his allies. And we have yet to hear from Trump on any of the appointments or names that he's really considering. But throughout the trail, he's sort of hinted at certain people who he'd like to see in the top brass of his next administration. Some of the names, including Elon Musk and RFK Jr., came as a surprise, but more and more recently, he's been continuing to float those names. So we might see the two of them in some sort of high position in his next administration. And then beyond that, hearing that a lot of the folks that he had towards the end of his last administration could play another significant role. They might just assume the same position or find a new role within this administration.
Stephanie, I also want to pull up at this juncture WSL election go on the terminal here, because you already see the poly market betting on who Trump will look to nominate for Treasury Secretary, with Scott Bessent, longtime hedge fund manager, and also longtime hedge fund manager John Paulson, really high up on that list. The betting markets got us to a very good place in the last juncture. Wondering how
Bessent dominates here, right?
Yeah, absolutely.
In the betting
well, Bessent has also been a very close and formal advisor to Trump during the election, and also, frankly, wrote his Economic Club of New York speech in a lot of ways. So at the end of the day, it's interesting to see a lot of business business names up there. Do you know how he's going to treat the business community in particular, particularly when Howard Lutnick himself is on this team choosing who would be in these spots?
It definitely does. Yeah, Wall Street players are going to continue to play a big role, whether or not it's in actual positions or just advising the people who end up in these positions. It's very clear that Donald Trump has continued to surround himself with these major Wall Street players. And I think in some ways, the people who are closely following the Treasury pick are thinking that this will signal to the markets that he's, really playing a professional look at his next administration. He doesn't want to fill it with just his allies or, whoever's loyal to him the most. It's really who will be the most expert in that role.
Right. Stephanie, got to leave it there. Really appreciate your reporting. Our thanks, of course, to Bloomberg's Stephanie Lai. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. Let's get a check on this stock market right now. The S&P 500 higher by about 0.3%. We're higher by about 4.6% for the week. If that holds, this will be the best weekly performance of 2024. And it's been a busy week. So some green on the screen to end it potentially. But then you take a look at big tech, not the same story. Tech has been an interesting trade this week. It's an interesting trade today with the broader market up, but the NASDAQ 100 a little bit lower. And then you train your eyes on the bond market. It was quiet early this morning, but now you can see investors coming in, buying the backup in yields that we've seen. 10-year yields down about 6 basis points. Coming up, we'll speak with the CEO of Tanger Outlets, Stephen Yalof, coming up next. This is Bloomberg.
The National Retail Federation sending a stark warning. It says consumers will pay as much as $24 billion a year more for apparel, for clothing, if the planned Trump tariffs are enacted. The survey also noted the proposed tariffs would be too large for retailers to absorb. For more, we're joined by Stephen Yalof, Tanger CEO. Great to have you here in studio. Great to get to check up with you again on the consumer. And I want to get to sentiment in a moment because it was very strong. But the tariffs are front and center post-election. We don't, of course, know what's going to happen, but what are your concerns? How would you offset that kind of tariff?
Well, first of all, if the tariff is passed back to the consumer, then obviously there's going to be a sentiment to shop in the locations that will provide the consumer the best bang for their buck, where they can get great value. And I think where we live is in that value sweet spot, right? Obviously the outlet business, value every day, great brands. So, we've gone through many cycles. We're a 43-year-old company. We're public over 30 years. And through those cycles, we've endured large tariff increases. We've endured cost of goods sold increases. And because of that, the consumer really finds our channel, and it's actually a safe spot for them to go and get things they love at the best possible price.
We'll talk about those past cycles, those past experiences you have. When you look to 2016, for example, do you have a blueprint for how, of course, the retailers that you work with might respond? What does that typically look like, and what might investors expect?
I think, first of all, the consumers are selling out. Now, most of the retailers in our space have a full price channel. They have an online channel. Some of them have a wholesale channel where they're distributing through department stores. And they actually look at the value channel or the outlet business to be a place that they clear excess inventory. So should they find buildup of inventory in their full price stores or their online channel, they can quickly move inventory into our sector in order to close it out and clear it at, like I said, at value price. In some instances, meeting that consumer where they are and getting a great return on sales. And in other instances, just liquidating inventory and turning it into cash.
You know, it's interesting. When we think about the tariff policy, a lot of people think inflation immediately, but the bond market thinks about that too. You have seen tremendous volatility this week alone. You are now seeing long-dated bonds really start to correct, if you will. You're starting to see a bid back into them. The rates are not as high as they were Wednesday. And so...
Or as they were Friday.
Or as they were Friday. So how do you think about this as somebody with a large real estate footprint? Is that volatility a problem for you as you make plans into next year?
Well, you know, first of all, we've got about $1.5 billion in debt. Now, we don't have a major tranche coming due until late in 2026. We did have a large tranche that came through this year that we had to refinance. And, you know, obviously that was an interest rate headwind for us. You know, we see the rate cut that happened yesterday as a positive thing for us as we think about refinancing. But we've got great access to capital. There's a strong acquisitions market out there right now. And we bought 2 centers last year, and we're definitely in the game with regard to buying new centers on a going forward basis. And, you know, with our access to capital, I think it puts us in an advantaged position to go out and source and ultimately close on some new product.
I wonder how the consumer looks to you. As I said, we got University of Michigan data, and it's not clear how much of the election it encapsulates, but it still is strong. 73, we were looking for 71. We talked to Erin Browne from PIMCO earlier today, and she says that the consumer has remained resilient overall and focused on value. Is that what you're seeing as well?
It is, and the retailers are saying the same thing. You know, I think that there's a strong push to, there's always going to be a push to brand. You know, we read the latest on luxury and sort of the bottom falling out of the luxury market a little bit. But great brands, great apparel brands, those the American accessory brands like Coach and Kors and brands like that, Kate Spade, seem to still be fairly resilient, and we think that they're going to have a great quarter, particularly going into this.
And you have those. You have Ralph Lauren. You have Nike. What are your biggest brands?
We do. Those are our biggest brands. Yeah. You know, and you know, for us, it's also the customer. Look, we have to fight like everybody else to get the consumer into our shopping center. They're not just going there for value; they're looking for entertainment too. So I think that's a really important part of what we do as developers. Is we want to make sure that we're bringing a full. You know, a full concert of things for that customer to do when they come and shop with us. That's why we've gone after better restaurants. That's why we've gone after better entertainment uses, to fill some of that space, to give that carload of customers who come and shop with us. The shoppers will shop. Some people in that car aren't thinking about shopping. Will go, you know, play putt-putt. They'll go to Pop Stroke. They'll go to Shake Shack. So we're looking, you know, we're competing to get the customer into our centers.
So a mix, of course, of physical goods and actual experiences. I want to talk a little bit more about some of the brands. Let's name drop a little bit more. You have Warby Parker, Victoria's Secret, Ulta, Sephora. That's interesting, too, on the beauty side. What are your best performing categories right now when you consider apparel versus beauty versus restaurants, for example?
And I just looked at that. And what's so interesting, they're not performing by category, they're performing by brand. So some of the brands that you just talked about, you know, Brooks Brothers is performing really well with us right now.
Wow.
Exactly. Sephora, you know, we put 5 new Sephoras in our portfolio, brand new to outlet. Now, they're selling mostly full price product in the outlet environment, but they see an outlet customer, they see it as an opportunity to meet a new customer where they are. And we just did, as a company, a day of beauty. And basically what we did was a local advertising campaign in most of our markets that have either Ulta, Sephora, also Estee Lauder has cosmetics company, which is pretty big in the outlet space too, to bring that customer in, that local customer in to shop that particular brand. And it turned out to be a great win for us. So that category is doing extremely well.
So some of these brands you've named, one reason they have been under so much of investors' kind of focus here, Brooks Brothers bought in 2020 by Authentic Brands. You mentioned Coach, Tapestry. Deal fell through there, but you gotta wonder if in a new administration those deals come back. How do you view this potential? Do you think there's gonna be more consolidation among those brands? Is it good or bad? What does it mean for the American consumer? You experience kind of a very intense view of that from where you sit.
Well, look, Tapestry is an operator, probably one of the best operators out there. You know, when the deal fell through with Michael Kors, you know, my personal opinion on that was, you know, it would have been great for Michael Kors to benefit from the Tapestry leadership. But, you know, Michael Kors, again, is a great brand that's got great resilience. And I think, I think of consumers as fans of brands, particularly in our space. I think of the consumer as a fan of a brand. They're not shopping with us to just go find a jacket or a polo shirt or a pair of jeans. They're very focused on the brand that they want to buy. They want sneakers. They want to go to Nike or they want to go to Adidas. I mean, it's one or the other. You're not comparing which one has the better deal that day. But you're very fortunate that in our centers, Nike's on sale every day, Adidas is on sale every day. I just think that that's the consumer wants the brands they love at the best possible price. That's what we get to deliver to them. And I think the best retailers are the ones that are focused on that and delivering that product and making sure that the inventory is there, that the customer service is there, because that's the main differentiator between online shopping and in-store shopping is that customer service element. And the people that are bringing the best customer service to the table are the brands that are really winning right now.
And a good reminder, too, that brand loyalty, it's a tangible, real thing. Stephen, we got to leave it there. So great to see you in person again. That, of course, is Stephen Yalof of Tanger.
So you're a Hoka person, though, right?
Yeah.
Didn't you have brand loyalty previously to Nike and then make a switch?
I kind of switched around. I was with New Balance during college, but Hoka, I put them on, the cloud-like cushion of that maximalist shoe, and I was like, this is the rest of my life. So
you got to try the Skechers running shoe. Do you run?
I do.
So Skechers just sent me a running shoe.
Yeah.
Which you want to sleep with them on. They're like slippers. It was the best. I'll send you a link to the shoe that they sent.
All right, we'll see.
And they're expanding. They're growing like.
She's open to switching.
Yeah.
Saying.
I will do the reporting necessary to make the decision.
Yes.
But in any case, Stephen, great to see you.
Thank you for having me on.
Coming up, we'll talk about Affirm as well, seeing a big jump in volume and resuming in the fiscal first quarter. We're going to speak with Max Levchin. He is the company's CEO next. This is Bloomberg.
Buy now, pay later giant Affirm is seeing strong gains to start their fiscal year, seeing volume grow by 35% and revenue growing by 41% as it paves the way for holiday season. Joining us now is Max Levchin, Affirm's own CEO. Interesting, Max, I do want you to address the numbers themselves first, because even though you're seeing this hike in volume, I would say you're seeing also akin to what a lot of other financial companies are experiencing right now, which is more volumes, but also kind of some slight deterioration in credit quality, I would describe it perhaps. As you see those increase in volumes, that seems to be what's spooking investors, at least on the upfront. How are you talking to investors about this dynamic?
I'll respectfully disagree. I don't think we're seeing deterioration of credit quality at all. If anything, we are seeing extreme stability of credit quality in our portfolio. The fluctuations in delinquencies are seasonal. They always are. Perhaps that is what you're referencing. But just to reiterate, our credit quality is a setting. Our loans are very, very short term. The weighted average is something like 4 or 5 months. We decide what it is that we're going to risk every quarter. And by halfway point of the quarter, half the volume has already been paid off. And so our risk is inherently controlled by the settings that we make in credit. The volume we're seeing and the revenue growth we just posted speak for themselves. We're doing really, really well. Very excited about the holiday season, obviously, but the credit quality is exactly in the kind of control that we want it to be.
That's fascinating. And as we see inflation come down, I guess, and we saw consumer confidence very strong today. That's all good news for you. I wonder about your stable of merchants. And specifically, Max, I'm wondering not just who and how quickly it's growing, but how does a merchant come to a decision, we're going to work with Affirm, we're going to establish buy now, pay later, and it's better for our business? What kind of arguments do you think they go through?
So, this is kind of the pivotal moment. Until about even maybe 2 quarters ago, we would come into a merchant conversation, small or large, and say, hey, buy now, pay later is a thing. Look at us. It's 6-7% of e-commerce. You're missing out. You got to turn on Affirm. There are all these people. It has flipped. We're just 500,000 active in the last 12 months, shy of 20 million active consumers. The conversation isn't about should we use this or not. We're sort of past the point of niche, interesting thing that some kids are using these days. It is a massive trend, buy now, pay later writ large, and Affirm within it is the largest. We're half the revenue of the whole industry. It is now a conversation of, can we implement this before the holiday season, or do we have to wait until January? The demand from the merchant side of the house is really, really strong right now, especially as we head into the holidays.
Is there kind of an indirect way to use Affirm with merchants that don't necessarily work directly with you? I mean, can I go around and through Apple Pay, for example, or through Amazon Pay?
Thank you for teeing that up. I should have mentioned that we are integrated in your favorite digital wallet, whatever it is. We have a massive digital wallet strategy that is just really beginning to roll out. Obviously, you mentioned a few names. We are in all of those. We're in Shop Pay also. We are in Amazon Pay. We are in Google Pay. There's a million places, and half dozen places you can find us. And it's also no secret that our probably my favorite product anyway is the Affirm card. That is something we launched at scale about a year ago. We just posted just shy of 1.5 million active consumers. Those are the strongest, most committed consumers we have in our portfolio. They use the card all the time. They're basically shifting it to be their top of wallet product. So very excited about that. But Affirm is available to you both at the point of sale and in our app.
You know, the interesting thing about the Apple Pay deal, we spoke just months ago when you really had it start taking off. What is the uptick there? How are you seeing the platform being used on third parties?
So we spoke months ago about the impending launch, but it's only been around for a couple of weeks. So it's a little too early to report progress there. We're very excited about not just Apple Pay, but our entire wallet strategy. It has worked really well for us so far, and obviously this particular one is one of the most popular.
On the credit cards in particular, it's interesting because when you think about the buy now, but you and I have talked about this so much, where does the credit card industry fall in relation to where you are playing, right? Where does the discrepancy happen? And with the Affirm card as well, how are you competing at perhaps a whole new scale?
That's exactly right. We are going offline with the card. That's the single most important thing about what we did with the Affirm card. It's a great alternative to credit cards. It works online, works offline exactly the same way. You program in the app whether you want the next transaction to be a loan or a pay now. You can also decide afterwards if you wanted to turn it into a loan. It's very versatile, and half the volume of our Affirm card consumers is offline, and it's growing very rapidly. Last quarter, this number was 45%. The quarter before, it was just north of 40. So people are learning that Affirm can be helpful to them where they go shopping, be it for a party, cart full of groceries, or for a big screen TV, or online. And so we are replacing credit card volume. Fortunately, there is a plus or minus $1 trillion of e-commerce alone and a few $1 trillion of non-e-commerce transactions. Most of that is on credit cards and debit cards, and that's what we're eating into.
Max, we had a Fed meeting that was pretty uneventful yesterday, with the exception of some talk about whether or not Trump could fire Powell. That has nothing to do with your business, but they did say that the employment picture is starting to ease up a bit. And I wonder if you noticed that in your business as well.
As I mentioned, we are feeling very good about our credit performance, credit outcomes. The most important metric I track in terms of macroeconomic state of affairs in this country is employment. So any good employment news is great news for us. We have not seen deterioration in our book. And so from my point of view, it's always been good news. It's been very steady news, which is the best kind. But anything Federal Reserve has to say about the stability and improvement in the job market is just going to accrete to our bottom line, which we will happily reinvest to approve more folks, to drive more exciting deals, et cetera. So from my point of view, the Fed news were great news yesterday.
All right, Max. Really fascinating stuff. Great talking to you. Thanks so much for joining us on Open Interest. Max Levchin there of Affirm. Coming up, traders pile into ETFs following Trump's election win, with one index seeing its biggest one-day inflow in over 17 years. Details next. This is Bloomberg.
Well, the election this week spurred a wave of ETF buying. On Wednesday alone, $18 billion was added to U.S. equity ETFs, 16 times the daily average inflow for 2024. Let's break it all down with Athanasios Sarafagis from Bloomberg Intelligence sitting to my left. And I don't even know where to start with you because we have small caps, we have Bitcoin, we have bonds, all of these funds just seeing enormous inflows. I guess to some extent we were expecting some volatility, but even still, just the billions of dollars have been staggering.
Yeah, it's been 30 billion or so in 2 days. It's good breadth too. Mostly, a lot of ETFs are taking in money. I think the usual suspects, small caps, Bitcoin, financials. No love for international though. Of those flows, about 90+% has been all U.S.
Oh wow.
Yeah, so they haven't been any bites
America
outside the
first.
U.S. Yeah.
Well, speaking of America first, the Treasury market. I'm so interested in what you saw in TLT this week.
This is the trade that it's broken a lot of hearts for a long time. People waiting for rates to come down. The trade hasn't worked. It didn't work after the election, but it's working today. So a bunch of people piled into this TLT trade. There's also a 3X version of that that a lot of people have piled into. They must love punishment, but I think they're hoping that it might work this time.
Dude, first of all, you look pretty chilled out. Wasn't it like an amped up week?
Was Eric Balchunas not like pounding the desk?
Yeah, we have to cancel each other out. He's very amped up. I'm like the chill one, and it sort of just balances out the whole team.
Did you see jumps in Trump-related ETFs? I know MAGA is one, and we saw a number of other Trump trades put on over the last 6 months. Did you see those accelerate this week?
Not like the specific ones, but small caps, I think, is one. Regional banks, definitely. China was down a lot. So I think when you put that all together, that's what would have been in the Trump ETF anyways. But that stuff did really well.
And let's talk a little bit about Bitcoin. Bitcoin, of course, hitting record highs this week. IBIT, this is BlackRock's Bitcoin fund, their spot Bitcoin fund, taking in record inflows. I think it's interesting that this is more symbolically important, but IBIT now has surpassed iShares Gold ETF in terms of size.
Yeah, it is symbolic. Regardless of how you feel about Bitcoin, it's just like not going away, right? And so the interesting thing is gold has had a year this year. It's up like 30%. So it's able to catch up on gold despite its really big run. But they're both iShares products. I think they're just going to have to learn that they're going to be living together, right? I think gold and Bitcoin sort of offset each other. They're uncorrelated a little bit, but they're going to have to learn to live in this world together. But it's definitely a big symbolic change.
Bitcoin turned 15, I think, last month. Are you expecting a lot more crypto ETFs now that the incoming administration is expected to be so pro-crypto?
There's been all these altcoin filings.
Yeah, it's not going to be Bitcoin. I think that's pretty saturated, but it's going to be going really further down the trough into some of these altcoins.
All right, it's silly season.
I was just going to say, outside of Bitcoin, I think it's interesting when Robinhood came to us with the top things people were buying. A lot of it was just QQQ and SPY at the end of the day.
Yeah.
Simple. Easy.
That's so boring.
Straight. Straightforward.
It's not fun like triple leverage treasuries. Athanasios, it's always great to see you. Have a great weekend. That is Athanasios Sarafagis from Bloomberg Intelligence. And make sure to tune in to ETF IQ every Monday at 12 p.m. Eastern. It's me, it's Eric Balchunas, it's Scarlett Fu. It's a lot of fun. Let's take a look at these markets, though, because we'll find some fun there as well. The S&P 500 at session highs up about 0.4%. We are looking at the best weekly performance this year for your big index there. You take a look at the NASDAQ 100.
We're going to hit 6,000? We're going to hit 6,000 today.
We could. Don't jinx it.
No, it has to happen.
It has to happen.
Yeah.
You heard it here first. We'll see, of course. There's a lot of daylight between now and 4 p.m.
But not between 59.94 and 6,000.
I don't know. It's been a volatile
week. We're looking
week.
at 5+ points.
Yeah, but things tends to happen on Fridays, particularly in the afternoon. So
it's going to go there.
I don't know. Don't hold your breath. But in any case, really interesting week in markets, really interesting week in the economy, really interesting week in U.S. politics.
Yes, it has been. Absolutely fascinating. It's been an historic week. Thank you both for, being with us.
It was an honor.
And a House decision still ahead, just saying, we're not even done yet.
Yeah, that's going to finish up as well. Coming up on Monday on Open Interest, Rod Little is going to join us. This is Bloomberg.